Picture a coworker who retires at 58, decades earlier than anyone expected. No fanfare, no big announcement. She just stopped showing up, and a few weeks later, someone mentions she's traveling for 6 months straight. She drove the same car for 12 years. Nobody ever heard about a bonus, a big year, a windfall. Now picture the coworker down the hall, new SUV every 2 years, the one everyone assumed was doing well. He gets his wages garnished the same month, right after a lender finally catches up with him. Same office, same decade, opposite outcomes. If someone asked you which one was actually wealthy, you probably already have an answer. That answer is worth questioning. This isn't about who worked harder. It's about who spent money to look wealthy and who never bothered proving it. Call it the invisible wealth trap. Here are 7 reasons looking financially ordinary might be the smartest move you ever make. And one quick thing before we start. This is what it actually means to look poor on purpose. It doesn't mean neglected. It doesn't mean driving something falling apart or wearing clothes with holes in them or refusing to enjoy a single dollar you earn. It means nothing about your money is on display. That's the whole definition, and it's worth holding on to for the next 7 reasons. The first one is the simplest, and it changes how you look at every driveway on your street. Reason 1, what you see only proves the spending. You already do this. A nice car goes by, and some part of you guesses what's sitting in that person's bank account. Here's the first number, and it flips everything you'd expect upside down. A recent Goldman Sachs survey found that among households earning between $200,000 and $300,000 a year, 16% said they were struggling to make real progress on their long-term financial goals. Among households earning $500,000 a year or more, 40% said the exact same thing. Read that again. The people earning more than double are 2.5 times as likely to feel like they're drowning. That's not a typo, and it isn't a coincidence. That's lifestyle creep working exactly as advertised, quietly convincing a bigger paycheck that it needs a bigger life to match it. You probably felt that exact pull yourself the first time a raise landed in your account. Here's how that's even possible. A loan officer spends her whole career looking at 2 things side by side: what a person drives into the parking lot and what that same person's bank statements actually say once she pulls up the file. She'll tell you the 2 rarely match. The applicant in the least luxury sedan sometimes has $300 in checking and a maxed out credit card. The applicant in the paid off hatchback sometimes has $40,000 sitting quietly in a brokerage account, plus a fully funded emergency fund that neither the car nor the parking lot ever hinted at. The car proves exactly one thing: somebody somehow acquired it. That's all it proves. It doesn't tell you if they paid cash or financed it. It doesn't tell you the loan length if there is one. It doesn't tell you what's left over once the bill's clear, or whether there's anything left over at all. Here's the second number almost nobody sits with long enough, and it's probably the one you've measured yourself against without realizing it. The median household net worth in America right now is around $192,000. The average gets reported at over $1 million. That gap exists for one reason. A small number of extremely wealthy households pull that average number way up, the same way one enormous salary in a room of 10 people inflates everyone's average income without changing what 9 of them actually bring home. The median is the number that isn't lying to you. It's what a typical household actually has once every asset is added up and every debt is subtracted. There's a third number worth sitting with. The share of every paycheck that actually gets saved has dropped to around 3% nationally. Go back a few decades, and that share used to sit closer to 8%. In other words, you're probably banking less than half of what your parents' generation did, even as the cost of looking successful keeps climbing, and a fourth number closes the picture out. Could you cover a surprise $1,000 bill right now using savings alone, no borrowing, no credit? Just over half of American adults say they couldn't. That's the quiet truth sitting underneath plenty of leased cars and vacation photos. Your entire financial footing can depend on nothing but the next direct deposit landing on time. while you still look from across the street like everything is completely under control. This is where a quiet bit of psychology takes over, and it has a name: visibility bias. Human brains give enormous weight to information they can see and almost none to information they can't. We see the car. We don't see the loan sitting underneath it. We see the renovated kitchen. We don't see the home equity that got borrowed against to pay for it. We see the vacation photos posted the same week. We don't see the credit card statement waiting quietly at home. This is not about what you own. It is about what's left over once you own it. To be fair, none of this means a nice car is automatically a red flag, or that anyone flashing a little visible success is secretly drowning. Plenty of people driving something impressive have the savings and the investments to back it up completely. The point isn't to judge the car. The point is that the car alone can never tell you which kind of owner you're looking at. So it was never worth building an opinion on in the first place. That's the whole reframe this video sits on. Ownership is visible. What's left over is not. And what's left over is the only number that decides whether you actually become wealthy or just spend your whole life looking like you already are. Once that clicks, the next question answers itself. If appearance and wealth aren't the same thing, why does almost everyone keep spending like they are? That's the second reason. Reason 2, you're rarely buying the object. Here's a question worth sitting with for a second. Have you ever bought something you wanted for months, felt amazing about it for a few days, and then realized your life felt almost exactly the same as before you had it? That's not a coincidence. That's the trap working exactly as designed, and it's not rare. A survey earlier this year found that 62% of people who make impulse purchases have regretted at least one of them, and 34% say impulse buying has caused them real financial stress. The good feeling doesn't reliably outlast the receipt. Say somebody gets promoted, new title, new salary, a corner office with a door that actually closes. Within a few weeks, the wardrobe that felt perfectly fine a month ago suddenly feels wrong for the role. The old phone feels behind. The watch feels cheap sitting next to a title like that. None of these things stop working. They just stop matching the story the person now wants to tell about themselves and about who they've become. Psychologists call this social signaling. We use possessions to say things we're not saying out loud. I made it. I belong in this room. I'm not struggling anymore, so please stop wondering. There's also a name for goods that become more desirable specifically because they're expensive, where the price tag itself is doing most of the appealing. Economists call these Veblen goods. The stitching and the leather were never really the point. The number on the tag was the point. And then, almost without exception, the excitement fades. Psychologists call this hedonic adaptation. The new watch feels extraordinary for maybe 2 weeks. Then it quietly becomes normal, the same way the last thing did. Once it's normal, it stops delivering the feeling it was bought to produce, and the search for the next thing to buy begins again, usually without anyone noticing. It's the same cycle running twice. Researchers who study materialism and life satisfaction keep landing on the same uncomfortable finding. People who tie their happiness most tightly to possessions tend to report lower satisfaction over time, not higher, because the treadmill never actually arrives anywhere. The scenery changes, the feeling doesn't. It also explains why a raise so rarely feels like enough. The income goes up. For a short while, the new number in the account feels like plenty. Then the apartment starts to feel small, the wardrobe starts to feel behind, and the restaurants that once felt like a treat quietly become the new normal. Nothing about the actual paycheck failed. The bar just moved the same way it always does, and almost nobody notices it moving in real time. To be clear, there's nothing wrong with enjoying a well-earned reward. The issue was never buying something nice. The issue is buying it to answer a question that no purchase was ever built to answer. So ask yourself before almost any purchase, do you want this object, or do you want the identity you think it's about to hand you? Every dollar spent chasing that identity is a dollar that never got the chance to become wealth. That's the whole reason people on solid income stay broke for decades. That question explains why one purchase so rarely stays just one purchase. That's the third reason, and it's the one most people underestimate. Reason 3, one upgrade quietly creates 5 more. You felt this before. You just never had a name for it. A couple renovates their kitchen, new island, new countertops, and the whole room looks incredible, exactly the way the photos promised it would. Except now the old dining table looks wrong sitting next to it. So that gets replaced. The old light fixtures look dated under the new counters. So those go too. The backsplash that seemed perfectly fine last month suddenly clashes with everything around it. One renovation quietly becomes four, and the budget that covered just the kitchen never covered any of this. There's a name for this exact pattern, the Diderot effect, named after a philosopher who once received a beautiful new robe as a gift and slowly replaced nearly every other object in his study because none of it felt worthy of sitting next to the robe anymore. The same thing happens in a closet, a garage, a driveway. One nice thing quietly makes everything around it look wrong. The same chain runs through much bigger purchases. A larger house isn't just a bigger mortgage payment. It's more property tax, more heating, more cooling, and more furniture required to fill rooms that didn't exist a year earlier. A nicer car in the driveway can quietly create pressure around the clothes worn getting into it and the restaurant chosen for the drive there. Move into a more expensive neighborhood and an unspoken expectation arrives along with the mailbox key. Which landscaping company gets used, which school the kids attend, which vacations get mentioned at the block party without sounding like bragging. This is the lifestyle multiplier. The real cost of a purchase was never just the number on the receipt. It's everything that purchase quietly convinces a person to buy next, one reasonable sounding decision at a time, until an entire life has rearranged itself around a single choice nobody remembers making so deliberately. A recent survey found 42% of Americans feel overwhelmed by clutter in their own homes frequently or all the time. That's the multiplier showing up in physical form, years after the first purchase started the chain. The expensive part is almost never the item itself. It's the entire lifestyle the item quietly asks you to build around it. Raises come and go, and the person never gets wealthier because the lifestyle is always one purchase ahead of the paycheck that's supposed to be building it. Every one of those small decisions has a price tag most people never calculate. The fourth reason puts an actual number on it. Reason 4, the real price is what the money never got to become. Let me walk you through a number that's more painful than most people let themselves sit with. Take the most visible status purchase in American life, the vehicle sitting in the driveway. The average loan on a new one right now runs close to $44,000, and the typical monthly payment recently set a record at $770. Roughly 1 out of every 5 new vehicle loans today comes with a monthly bill above $1,000. To keep those payments manageable, lenders have quietly stretched repayment windows out further than they used to. Nearly a third of new auto financing now runs past 6 years, meaning plenty of buyers are still making payments on a vehicle that finished losing most of its resale value long before the loan itself wraps up. Nationwide, auto debt has climbed past $1.685 trillion, edging past the country's entire student loan balance. Here's a calculation almost nobody bothers running before signing the paperwork. Picture someone skipping the new loan entirely, driving something reliable and already paid off, and redirecting that same $770 every month into a low-cost index fund instead. Run that for 10 years at a typical long-term return near 7% above inflation, and the account holds somewhere around $133,000. Stretch it to 20 years and the balance is closer to $400,000. Stretch it to 30 years and it lands just under $940,000. That's the actual trade nobody puts on the sales contract. Finance the newer car and the upgrade shows up this weekend. Skip it, and that same person 30 years from now is looking at an account worth just shy of $1 million, built from nothing more dramatic than one ordinary decision, repeated every month for 3 decades. And that's before counting the second cost that never shows up on the window sticker. Insurance runs higher on a newer, pricier vehicle. A car typically loses roughly a fifth of its value before its first birthday. Stretch the loan out long enough, and there's a period where the amount still owed is bigger than what the car could even sell for, which means totaling it or trading it and leaves a bill behind with nothing to show for it. If you've ever wondered why a car payment never seems to end even years in, that's usually why. And this particular bill doesn't wait 30 years to show up for you. It shows up monthly with interest riding along. Credit card balances nationwide have climbed past $1.25 trillion, and among households actually carrying a balance, the typical amount owed sits close to $6,700 at an interest rate that averages near 21%. Stick to the minimum payment at that rate, and a balance that size can take well over a decade to clear, sometimes twice that depending on the card's minimum payment formula, quietly tacking on thousands more in interest than the original purchase ever cost. The lifestyle got financed, so did the privilege of financing it. To be fair, nobody watching this needs to feel guilty for owning a nice car or for occasionally financing something. The question was never whether the car is nice. The question is whether that payment is the reason you're still broke in 30 years, driving something nicer than the version of you who invested instead. Money isn't the only thing an expensive image can cost, though. Reason 5 is far more personal. Reason 5, staying quiet protects more than your money. This is more common than you'd guess. It might already be happening to you. A woman gets a bonus at work and mentions it once offhand in a group chat with old friends. Within a month, a classmate she barely speaks to anymore asks to borrow money. A cousin starts hinting about a trip they can't quite afford on their own and somehow expects her to close the gap. A friend who used to split the dinner bill evenly starts quietly assuming she'll cover it going forward without ever actually asking. Nothing about her financial reality changed. What changed is what people now believe about her, and belief turns out to be almost as expensive as money itself. That's the practical case for staying quiet. Once people know or think they know what somebody has, expectations start forming around it, usually without a single conversation ever happening out loud. Researchers who study this call it expectation formation, and it works quietly in the background of almost every relationship touched by visible money. Some of those expectations are harmless. Some quietly become financial pressure, and some become a genuine safety risk, since a lower financial profile is simply a smaller target for theft, fraud, and the kind of scam that specifically hunts for people who look like they have something worth taking. A car that draws attention in a parking lot draws the same attention from the wrong kind of person. A home visibly full of expensive new purchases signals exactly what's inside to anyone paying attention from the street. There's a relational cost too, and it's quieter than the financial one, though arguably it cuts deeper. When people know somebody has money, they sometimes behave differently around that person without even realizing it themselves. They laugh a little harder at the jokes, they return calls a little faster, and it becomes genuinely difficult to tell whether a friendship is about the friendship or about what it might eventually provide. Wealth cues, once they're visible, quietly change the behavior of everyone standing near them. None of this means hiding wealth out of guilt or pretending to have less than what's actually there. It means understanding that not everyone needs enough information about your finances to build expectations around it. A handful of short sentences cover most of it. That's not in my budget this month. I'm not able to lend that right now. No, with no explanation required afterward. Privacy isn't secrecy. It's simply refusing to hand out information that other people don't actually need. This reason works differently from the others. It isn't about becoming wealthy. It's about keeping what you've already built from being quietly drained by other people's expectations or taken outright by someone paying closer attention than you realize. If all of this sounds unusual, that's only because most of what we see about wealthy people isn't actually wealthy people. It's a performance of them, which is exactly what the sixth reason exposes. Reason 6, real millionaires look nothing like internet millionaires. Social media shows you the exact moment money gets spent. It almost never shows you the 20 years it took to quietly save it. Let me show you what the actual research found, because it's almost nothing like the picture in your head. A well known survey of over 10,000 American millionaires found that only around 31% of them average a six-figure income across their entire career, and a full third never earned six figures in even a single working year of their working life. Close to 80% received no meaningful inheritance at all. Roughly 8 out of 10 of them consistently invested in an employer retirement plan, and most eventually owned a home outright, free of any mortgage. What they have, they built themselves, from ordinary paychecks and decades of consistent, unremarkable habits. If you pictured a private jet or a walk-in closet full of logos just now, the picture in your head was wrong. That's the whole trick this reason is built on. None of what these people have is an accident. They're wealthy specifically because the money that would have gone toward looking rich stayed invested instead. To be clear, none of this describes the handful of billionaires who show up in headlines. This is about the regular millionaire next door, the kind with one to a few $1,000,000 in net worth, built slowly over a working lifetime by somebody who could easily pass unnoticed at the grocery store. That same research found these households typically spend around $200 or less a month eating out total, which might be a smaller restaurant budget than yours, even if they're worth a good deal more than you. And when researchers looked at what these households actually drove, the results surprised almost everyone who assumed otherwise. A widely cited study from Experian Automotive found that 61% of households earning over $250,000 a year don't drive a luxury brand at all. They drive Hondas, Toyotas, Fords, the exact same car sitting in an entirely ordinary neighbor's driveway, parked next to a garage door that needs a fresh coat of paint, maybe even the same car sitting in yours. That's the gap between wealth as a performance and wealth as it actually exists. Online, wealth looks like private flights, designer bags, and a car that costs more than most people's first house. In real life, it usually looks like a paid-off used sedan, an unremarkable three-bedroom house, and a brokerage account nobody watching from the sidewalk has ever seen or ever will. Even at the very top of the wealth ladder, the pattern holds. Several of the most recognizable founders in tech, people worth many billions, have been photographed for years driving cars an entry-level manager could easily afford. What their money buys them is never having to think about the car at all, not a badge on the hood. All of this saving and quiet discipline is pointing towards something bigger than a number in an account, though. The seventh and final reason is what it's actually pointing toward. Reason 7, the real prize is being able to say no. You've probably watched this exact split happen before. Two friends graduate the same spring and land almost identical starting salaries at two different companies in the same city. Whitney treats the new paycheck like proof she's arrived. A newer car within the first year, a one-bedroom apartment she picks mainly because the finishes look nicer than anything she grew up around. Every bonus after that goes toward upgrading something she already owns. Caleb treats the new paycheck like nothing has changed yet. He keeps the car he drove in college running, the same choice that quietly built the six-figure gap from a few minutes ago. He finds a roommate instead of living alone, and every month before he ever sees the number sitting in his checking account, part of it disappears automatically into an index fund and a smaller part into a cash emergency fund he treats as untouchable. For a long stretch, Whitney looks like she's winning and Caleb looks like he's being cautious for no real reason. Then both of their industries hit a rough patch in the same year, and both of them lose their jobs within a few weeks of each other. Whitney has a car payment and a lease that don't care that the income stopped. She takes the first offer that comes in on whatever terms are attached because the bills can't wait around for a better one. Caleb has years of that cash emergency fund sitting exactly where he left it, untouched by the layoff and untouched by the market. He can afford to wait. He passes on two roles that aren't a fit and takes the third entirely on his own schedule. Nothing about their starting point was different. What was different is what each of them was quietly building underneath the version of themselves other people could actually see. That's the real return on all that quiet saving. not a bigger number sitting in an account somewhere, but genuine leverage. Can you leave a role that's slowly wearing you down? Does unpaid time off feel possible when a parent gets sick? Can you relocate for a relationship or a shot worth taking, or try something entrepreneurial without a safety net waiting underneath, or turn down a paycheck attached to something that doesn't sit right? None of that is available to you if your spending tracks your income dollar for dollar. It's only available if you've built real distance between the two. That distance, not the number on your pay stub, is the actual mechanism. Match your spending to your income, and you can work your whole life without ever getting ahead of it. Keep spending below it, and that gap is what turns into wealth, then keeps you wealthy once a bad year tries to take it away. It stays invisible for years, right up until a single hard season proves which version of the two friends was ever real. That's all 7 reasons. None of them ask anyone to live small. They just ask where every dollar is really headed. None of this means never enjoying your money. A genuine luxury purchase is a perfectly reasonable choice when the savings are strong, the investments stay on track, and the purchase isn't quietly financing an identity at the expense of real security. The dividing line was never the price tag. It's what the purchase does to the rest of a person's financial life once the excitement wears off. So here's the whole thing distilled into something you can actually use. Decide what enough looks like for you before your next raise arrives, so the finish line stops moving every single time you get closer. When income rises, let investments rise with it before lifestyle does. In that order, moved automatically on payday, before there's ever a chance to get used to seeing it sit in the account. Keep the full cost of a purchase in view, not just the monthly payment attached to it, and measure progress by net worth, quietly tracked in private instead of by anything a neighbor could ever see from the street. Go back to that early retirement one last time. Same car for 12 years. No big announcement, just 6 months of travel that quietly confirmed what the paycheck never advertised. And go back to the coworker down the hall, the one everyone assumed was doing well. Wages garnished the same month it all caught up with him. That's the invisible wealth trap in full. It convinces almost everyone to compete on the one number that was never the real scoreboard. She was never poor. She simply stopped keeping score on the number everyone else could see and started keeping score on the one nobody could. Looking poor was never the weakness people assume it is. It was the strategy the whole time. That's the whole switch this video is asking of you. Not less spending for its own sake. A different scoreboard entirely. If this resonated, subscribing is the simplest way to keep seeing breakdowns like it. And there's another one waiting on your screen right now, worth watching next.